All right, welcome to our webinar on taking advantage of bad markets and low interest rates. Yes, we're seeing all that stuff taking place in the market right now, and that doesn't make clients feel very comfortable. When you see this kind of thing happen in the market, of course it does happen on a regular basis, right? Fortunately not often, but it is regular. If you look back through history, we'll see market corrections taking place. We always want to be in a position where we can take advantage of those corrections. Not everybody has the opportunity to, and this call's caveat is that today's topic is for your top clientele, those with more money than they know they need for the rest of their lives, and potentially a taxable estate. Depending on where you put that at today's numbers, that's at 11.58 million. In reality, I like to keep my eye on the $5 million ball because most of my clients don't plan on dying in the next few years. And in reality, a lot of these clients are the clients who've already given away that tax-free amount, and so they're already into their potentially taxable realm. They're looking for additional advantages to be able to give things away, and by doing that, if we can do that in the most tax advantageous manner, bad markets and low interest rates give us a great opportunity to do that, right? We see the markets tank like this and go way down in response to some kind of stimulus. In this case, COVID-19 was one of the big drivers of that market drop. Not all rational behavior necessarily naturally causes market reactions like this from our clients. Never comfortable when those kinds of things happen. So we want to be able to be there to ride in our white horse and sort of save the day. The government helps out with that too, right? Because fear is every place in the market. In fact, if you look at the top 10 fears from Chapman University's study here, you'll see that a lot of these things are being triggered, right? If this is the top 10, look at what we're hitting. Corruption of U.S. government officials. Well, we've already seen Congress people trading on insider information they got about the virus. Number 4 is not having enough money for the future. Obviously, that money going down in value scares a lot of people, whether rationally or not. Even your clients with plenty of money, it doesn't feel comfortable when things go down. And of course, 5 and 6 are people I love becoming seriously ill or people I love dying. These are fears that people have. You see them every day going out there in the newspaper and everything else. So this is something that we want to be able to attend to with our clients. The government also steps in, puts in stimulus packages, as we've seen, and one of the things they've done, of course, the Fed has lowered interest rates. So this was an unexpected rate cut that we recently got. On March 15th, 100 basis point Fed rate cut was put into place, and that's going to lower interest rates across the board. So when bad markets and low interest rates collide, opportunities start coming up for us with certain kinds of techniques. We all know that those interest rates get reflected into certain things that we use in types of transfers. So April 2020, the April Federal rate chart came out. Here's that rate of charts which lays out all the different rates for the different periods of time. So you can see in the short-term and mid-term period of time, we're at about 1%. And of course, the midterm rate is the trigger for the 75-20 rate. That's the one that we use for Grats and Gruts and Crats and Cruts and Clats and Cluts and Cuperts, right? By definition, it's 120% of the federal midterm rate. Midterm rate's 1%. That makes the federal midterm rate 1.2% for the 75-20 rate used for those split interest types of transfers. If it's a straight loan, the loan's going to be based on the amount of time, short-term, mid-term, long-term, that it goes for. But if it's a Grat, Crat, Clut, or Cupert, you're going to use the 75-20 rate instead. Okay? Regardless of the exact rate, rates are low. In fact, they're the lowest we've ever seen in the charts. So what do we want to do? We obviously want to turn lemons into lemonade. So our clients need to hear from us, right? 3 key things that I see clients want to have from us when things are bad. When things are bad, number 1, they want to hear from you, right? Don't be silent. That just let them wallow in their fear. Show them that you're looking at their situation. Reassure them that things are great. A lot of our firms have put out wonderful messages that go out in broadcast ways to our clients that help them to understand what our positions in the markets are and the kind of things they should do. And we should reinforce that with our top clients by giving them a call and having a talk with them. So number 1, we want to hear from us when something's going on. Number two, when hearing from us, be empathetic, obviously, but be positive. Don't be silly, don't be ridiculous, but be positive in the messaging that we're bringing across. And that brings us to number three, in that positive response, not just it'll be okay and we're going to go through this, but bring an actionable idea to the table, right? Even if it's not appropriate for this client, it might be appropriate for somebody else that they know. It could be a fantastic opportunity to get introduced to somebody whose advisor is not doing those things we just talked about, right? Getting heard from, being empathetic and positive about what's going on, bringing actionable ideas to the table. This is when the top advisors start separating themselves from the pack. It is critical for us to be able to do that. So what kinds of things can we do? Let's focus in here, since these are short sessions, and we're not going to go through all the details of how these things work, because obviously you should be familiar with the different tools that we're using. If you're not, we can lead you to the right kind of resources. We certainly have classes and teach this kind of stuff as a regular matter of principle. But what we're going for here is a zero gift transfer. Zero gift transfer, meaning I'm going to make a gift, but that gift is not going to have any value for gift tax purposes, so it doesn't even register. So whether I've used up my exemption already doesn't matter. I can continue doing what we're about to talk about as much as I want to and for as long as I want to. So these zero gift transfers are very powerful techniques, and we'll cover a couple of different ways to be able to do it in here. But let's talk about the general idea behind this. That is the engine that makes the zero gift transfer work. Okay, the first thing we're going to do is we're going to have mom here, let's call her parent, and we'll call daughter over here child, and mom is going to make a transfer to her child. What she's going to transfer to her are assets that we believe are going to increase in value, right? She's going to transfer some sort of equity. I don't necessarily mean stocks, but anything that you believe is going to go up in value, right? We want something that's going to imply growth. So mom could give her daughter cash, and daughter could go out and invest the money. Or mom could simply take some of her investment portfolio and shift it over into daughter's account. Obviously, for every dollar that I transfer to the daughter, that would be treated as a gift by the gift tax rule. So let's just take a simple number and say that mom transfers $1 million. You can obviously scale this as much as you want to, add as many zeros. It's exactly the same regardless. Okay, so I transfer $1 million into my daughter's account. Here is what negates the gift. The daughter signs a note back to me. That is to say, essentially, I'm getting a fixed income interest in return for the gift that's being transferred to her. So if she says, I promise to pay you back, mom, that $1 million, then I have $1 million going to my daughter, $1 million coming back from the daughter, and therefore there is no gift. Those two things are of equivalent value. So that may also look like there's no value transfer here, but this is where we're playing off of the low interest rates. What we want to look at is the distinction in the growth of the assets that have been transferred to the child versus the interest rate that needs to be charged on that fixed income payment in order for it not to be a gift loan. Right? We just saw what the interest rates are. If we kept a lower midterm rate of return, if we did a loan for, let's say, less than 10 years, our interest rate should be about 1% right now. And so as a result of that, if you can get asset growth on the money that is in excess of 1%, all of that excess growth is shifted with no gift tax. It's not actually the $1 million that's being shifted. It's the growth on the $1 million. And so this is why capturing that bad market period where you believe that as things, whenever they do restore themselves, that the growth will take place in the hands of the next generation rather than yourself. Very, very important principle to understand. This is what happens inside of every one of these arrangements, regardless of how complicated the arrangement is, right? So we have intrafamily loans, we have private annuities, we have grantor retained annuity trusts, we have little variation on that, charitable lead trusts. We've got sales to intentionally effective grantor trusts. You can get as complicated as you want to in the wrapper that goes around it. But if you understand this foundational principle, every single one of them is operating off of this principle, except the charitable lead trust, but similar effect in terms of the growth portion of it. Just the payments are going to a charity instead. So let's just do a simple example. An intrafamily loan. Mom takes either cash or portfolio securities, and that's what makes this not work for a lot of people. It requires the liquidity to be able to do this. The other techniques do not necessarily. So mom takes cash or securities and transfer them over to the daughter. The daughter takes that money and invests that money, right, places it into the market, could even just keep it in the portfolio if the portfolio has been transferred over and the portfolio is appropriate to the current conditions that we have. Daughter signs a note back to mom. That note back to mom is going to say, I'll pay you back at the end of this period of time. You can make a balloon note, and we'll pay an interest rate, let's say, of the 1% on the note, our current applicable federal rate. As a result, if mom is giving daughter $1 million and daughter is going to pay back to mom $1 million plus the interest that's due on that note, so it'll be about $10,000 a year, she'll get back about $1,030,000. All of the value of the account over $1,030,000 ends up in the daughter's hot little hands over here, right? Here's a simple diorama that just shows you some of the math that might be associated with that. Again, I'm just keeping it simple, not compounding things and doing all the fancy stuff. They can go along with it. All of these are just based on assumptions, right? We're trying to identify, is there an advantage to taking part of this if we think that the markets will normalize over a period of time? Okay, so in this example, parents lending money to child directly, or if they want to retain control, of course, you can use a family partnership or a grantor trust, some other arrangement where the person running that arrangement is in charge of the decisions that are being made on behalf of the child. The parent's going to charge interest on that note in order to offset the gift rules, and that has to use at least the applicable federal rate in effect at the time. But here's the key, the total return in excess of the applicable federal rate is shifted to the family members with no gift. Okay, that's really the key thing that we're going for. And again, that's the key principle inside of each of these different types of arrangements. So using this example, we're using short-term AFR of 1% when the loan is made. Child takes a 3-year loan, let's say, from the parent and invests the money. We're making an assumption in this example that we're earning 10% a year. Just to make the math easy, you can make any number assumption you want in there. Use your client's assumption is the best thing to do in a proposal so that they would have some idea of what they believe that outcome would be. But we're just guessing. We don't know. As long as we earn more than 1%, that's really the bet. If we believe we can earn more than 1%, then we're not going to lose money in the transaction. Something is going to end up being transferred to the child gift tax free. It's just a question of how much. So the client lays out $1 million. Each year they get $10,000 back, the 1% interest on that loan, as well as the principal in the final year. And so the parent gets back their $1 million they started with, plus a little bit of interest along with that. Here's where the advantage of that low interest rate comes in. Not much has to be paid back in addition to the additional principal, the return of the principal. So the child's assets are growing. They've got $1 million, grows by 10%. That gives us another $100,000 on top. They have to pay a little bit of interest on that. And so they're down to $90,000. That $90,000 excess, $100,000 minus 10, gets added to the principal, which continues to grow at 10%. So we make another $109,000. Again, they pay off the $10,000. Add those two together, we're at $1,189,000. That's growing by 10%. Again, we're adding that piece onto the overall number, and we're paying back our principal, in this case, the $1 million, plus the $10,000. And the child would be left over with almost $300,000. $297,900, about $300,000 at the end of that transaction, with absolutely no gift tax cost. That's a 30% shift from the client to the child on value with no gift tax cost whatsoever. That's the engine that runs each of these different kinds of transactions. I may not have cash. Maybe I just want to do it with a basket of family assets or a family company or something like that. You can even get some additional discounting on those assets sometimes by putting that into something like a family-owned partnership and fractionalizing the interests in the arrangement. So we take a grantor retained annuity trust, for instance. We're familiar with the concept. You place assets. In this case, again, we've got the transferor over here who creates the trust. The transferor retains a fixed percentage annual payout, right? The code tells us exactly how that works. And so now we've got that fixed percentage coming back. That's the equivalent of our fixed income interest in the prior arrangement. Instead of it being a loan arrangement, it's just set up in a trust with an income interest and remainder interest. So the remainder interest, again, represents that child's interest in the property. At the end of that period of time, the money can go outright to them or into a trust for their benefit. Again, control is really the key driver on how you want to control the end result pieces of that. This is used very, very often in planning and ideally in situations like we have now. If I've got a small business and revenues are way down and we look at a valuation based on the current revenue streams associated with that business, you might be able to get a fantastically low valuation on the business because it is a valuation based on current market conditions and what that business would sell for between a willing buyer and a willing seller on that given date. So in a bad market period can be a great time to get those valued. In this example, I went a step further, took the $10 million of stock, let's say of a $100 million company, right? So we're talking about a portion of the company, a minority interest share. Our valuation from the appraiser might show a 40% minority interest discount just by the fact that it's a fractionalized interest in the arrangement. And so I take that 10% of the company in this example, which has a fair market value of $6 million because of the fractionalization, and now I transfer that into the Grat. With the Grat, I get the time value discount associated with it. And if you used a longer term, let's say a 10-year term, you'd have to pay back about $739,000 a year to the grantor. But here's where the lack of cash comes in. Because it's a Grat, I can make those payments in money or money's worth, which means I could simply use shares of the company to pay it back, right? If the company's going up in value, if the economy's recovering, if the revenues look better, each appraisal is going to show a greater valuation of the underlying shares. Even if it was equal, this would still work, but you want a growth in the underlying company. What ends up happening is you use less shares to make the payback than the percentage would normally look like, and that means there's money left over at the end. But that's not what the IRS's math says. When you do the IRS's math, what you do is you look at it only on day one, because that's when the transfer was irrevocable. That's when the transfer took place. So if we're transferring in $6 million, we just reverse engineered our way, given the time frame, into a payment amount that would also be equal to $6 million. So $6 million minus my fixed income interest being returned to me of $6 million gives me a gift of 0. That's what it looks like on the gift tax return. Very powerful. Now, if you had a growth rate during that period of time of just 8%, then you'd end up in the kid's hands approximately $3,700,000. Okay, very powerful technique to be able to put into place. Not everybody is thrilled about stretching that for a 10-year period of time because, of course, one of the risks in a Grat, unlike a lot of other arrangements, is if I die during the term of the Grat, most or all of the value is going to be includable back in my estate. So we tend to go on the shorter term end. So let's go closer to what we did in our loan amount. We'll do a 2-year zeroed-out Grat with exactly the same fact set. The payment stream would go up to about 53% a year, and the remainder would be worth about $635,000. On that 2-year period of time, then you can do that over and over. Every time a payment comes back to the grantor, you can take those same shares or whatever assets they are, put them into a new Grat, and continue on the process. Very powerful thing to do when we talk about what we often call rolling Grats, where you have Grat A here, and Grat A is going to pay out again to the family or into a family trust, however you want to have that from a control standpoint. Payment 1 from Grat A goes into Grat B, really comes back to the grantor and is recontributed into a new Grat. Payment 2 from Grat A goes into Grat C. Grat B, right, the second one we set up, payment 1 also goes into C, and payment 2 goes into another one, and you just keep doing this ad nauseum. So any excess wealth that somebody has, you can just roll those assets forward, what some people call cascading Grats or rolling Grat scenarios, where this continues until the client passes away if you want an unending cycle of that transfer taking place over time. Very, very powerful and popular technique. Interestingly enough, in difficult times, also, people are giving a lot of money to their favorite charities, to philanthropic concerns that they might have in the area. Maybe you could combine that and do what I often call a charitable Grat, right? Some of your clients might already be doing grantor retained annuity trusts and maybe have overlooked the idea of a charitable interest being included in this. The charitable lead trust works in exactly the same way from an economic standpoint. You can zero out the remainder interest in the arrangement. So you get a charitable lead trust, assets contributed in, against an irrevocable trust, follows all the same valuation rules that the Grat does, but the annual income stream in this case, instead of coming back to the grantor, goes to charity. So in effect, like you would pledge money to charity over time, you're actually irrevocably dedicating a stream of income to go to charity for a period of time. At the end of that time, whatever is left in the charitable lead trust ends up going to your beneficiary. So just like the Grat, you're leveraging that back-end gift. Just like the Grat, you can zero out that interest if that is desired. So the charity's payout term can be set for a fixed term of years. It can even be set for life. If this is a charitable intent that your client has for the rest of their life, that's the ultimate leverage on this arrangement. But even if it's just for a fixed period of time, using that bounce back period of time, making in effect an annual gifting arrangement to a charity through that period of time can be a very, very effective tool to be able to use. You can even do these on a testamentary basis because unlike the Grat dying during the term, since the grantor has no retained interest in the property, is not a problem. So charitable lead trusts, a fantastic alternative. The big difference in Grats strategically is that a grantor retained annuity trust is generally going to be shorter in the time frame, and it's going to be higher in its payout. With a charitable lead trust, same essential setup, but the charitable lead annuity trust, you're going to have a longer time frame in order to get the leverage because you're going to have a lower payout. Okay. Same strategy, two different variations on that strategy in order to take advantage of that zero value gift of the assets on the back end. And no loophole here. This is all completely codified. It's in the Internal Revenue Code. Congress gave this to us. It is simply our responsibility to take advantage of that opportunity. People also do this in things like sales to intentionally defective grantor trusts. It's the same idea. You create an irrevocable trust for benefit of the kids. You're trying to get assets out of your estate. And so this often starts with a seed gift. This may be transfers that your clients have already made into the kids' names. And so now you have a vehicle through which you can make various kinds of trades. If that vehicle has grantor trust status, that is to say, it treats the grantor as the income taxation owner of that trust, then it's a disregarded entity for transaction purposes. So taking the same idea as what we did before, I take part of my company stock, I sell that company stock to the intentionally defective grantor trust in return for a note from the trust. Well, bingo, bango, bongo, there you go. There's your asset that we expect to go up going in exchange for a fixed income instrument coming out. And again, exactly the same situation occurs. All of the excess growth in excess of the interest rate that needs to be paid on that note, which is, of course, relative to the time frame that we're operating there. Again, short and midterm should be about 1%. So the qualifying question for your client in an arrangement like this is, if we were to invest that money or look at the value of your stock over a period of time, right? You're looking at this. What do you believe the growth rate of those assets is going to be? Do you believe that we could outperform 1% a year? If their answer to that is yes, these techniques are worth looking at if the client already has enough money to live on for the rest of their lives. So the ultimate results of this obviously are a happy client and actionable ideas we can have out there. And even better, don't just help your client, ask them what other friends they have they might be talking to about those same issues, because this is stuff that applies to a lot of people. This is the time when the top advisors step up. They reach out to their clients hear from you, you're empathetic with them but positive, and you bring actionable ideas to the table that will help both your clients and others that they might be able to know. They look like a hero, you look like a hero, everybody makes out like a bandit, and it's a fabulous thing. Thank you so much for spending a little bit of time with us. Go out there and call your clients. It was great talking to you. And if you need additional information about any of these techniques or training in those areas, Cannon Financial Institute's always happy to help. Thank you so much.